A comment I often hear from commercial tenants is that they're sick and tired of flushing money down the toilet. The frustration arises when they have nothing to show at the end of their lease, so they feel all they did was pay their landlord's mortgage. But people may be surprised to hear that many companies intentionally lease space instead of owning it. I'm going to use Amazon to illustrate this, as they lease the vast majority of the warehouse space they occupy. And with over $33 billion in cash on hand, it's not a matter of them not being able to afford it either. Instead, it's a financial strategy that is shared with numerous other savvy companies. And in this video, I'm going to share with you why these companies don't feel like they're flushing money down the toilet. Let's look at this from the company's perspective. If management was considering purchasing a property, they would certainly create a projection on how they thought that asset would perform. This would likely include building out a performer for some period of time into the future. After accounting for the cash flows and an estimate for a sales price, they would then calculate the internal rate of return, or IRR. That might sound complex, but it's really just the annualized return over a period of time. I did a video explaining IRR in more detail if you want to go and check it out. Interestingly, there was a recent study done which showed commercial real estate investment properties averaged 9.4% yearly returns going back several years. Naturally, returns for each individual property could be higher or lower depending on local market conditions and what period of time the property was owned. But for the sake of this argument, let's assume the rate of return for investing in real estate is a nice round 10%. A prudent company will not just consider what this projected return will be, but they'll also factor in what the opportunity costs are of making that decision. In other words, could the company make a higher return by picking from all the other investment alternatives available to them? There's essentially an endless amount of options to choose from too. They could invest in machinery or equipment, they could start a new division or product line, or expand into a new market, or even acquire another company. In Amazon's case, they could have earned 10%, give or take, investing in real estate, but instead, their remarkable growth has been fueled in large part by their ability to earn much higher returns. It's a rhetorical question, but if you're a shareholder of Amazon, would you rather them owning their own real estate or continuing on the same path that's made them one of the largest companies in the world? Unless it's a very mature business with other avenues to deploy capital, purchasing a building will typically rank quite low on the list from an IRR perspective. Even in many business transactions, purchasers of a business will often model a sale and leaseback of the building to unlock the capital so it can be deployed for more fruitful alternatives that provide a better IRR. There are other considerations as well. For example, what happens if the real estate market takes a downturn? At the end of a lease, a company might not have anything to show, but surely this is better than being forced to sell at a loss. All things being equal, it will also be much easier for a company to move from one lease property to another than it would be to work through the sales process. Being nimble and flexible is of huge importance, particularly when a company is unsure of what their needs will be in the medium to long term. I can speak anecdotally to this as well, as I've helped clients expand into larger spaces within their current buildings. Landlords are always open to allow expansion within their own portfolios, and most of the time this happens without any penalties. This benefit does not exist whatsoever if the company owns their own property. At this point, you might be thinking I'm opposed to owning real estate, but as I've mentioned on other videos on my channel, I've actually got the majority of my net worth directly invested in industrial real estate. And I think there are entirely valid reasons on why a company might choose to own their own property. But real quick, before I get to that, if you're getting any value from this video, I'd greatly appreciate you tapping that like button. But back to why it may make sense to own versus leasing. For one, real estate has historically provided very steady returns, particularly when stretched over a long period of time. In some hot markets, it's conceivable that the appreciation of real estate actually outperforms other investments. It shouldn't be lost on anyone that large fortunes have been made by investing in real estate. Even beyond financial measures, owning can also offer more stability. When a company leases, they're somewhat at the mercy of the landlord. So if the landlord decides to sell the building or lease to another tenant, it might mean that the company is forced to move when their lease comes up. Then of course there's a possibility of rents dramatically increasing. Owning will naturally safeguard against those risks. The main point here is that there's a lot that goes into the decision-making process on whether to lease or to own. And the fact that many companies intentionally lease instead of owning means there are tremendous opportunities for investors to provide them with the physical real estate. Check out this video up here if you want to learn more about investing in industrial real estate. And if you're an investor, professional, or company looking to better understand the industry, my entire channel is devoted exclusively to industrial real estate. So please consider subscribing if you want to follow along. Thanks for watching, catch you in the next video.